In this video, we will look at consolidation with asset revaluation at the date of acquisition. Goodwill on acquisition. In the first example, with goodwill on acquisition, an investor acquires business control with goodwill. On 1st of July 20XO, Michael, an investor, acquired 100% of Summer's business ownership for 500 million. At the date of acquisition, Summer's business had share capital 200 million, retained earnings 280 million. Then there was machinery costing 533 million with accumulated depreciation of 53 million. So what it means is the carrying value of machinery is 480 million. Samuel has not revalued this asset at the date of acquisition. So Michael determined that the fair value of the machinery was 490 million, 10 millions more than the carrying value. Michael had issued 500 million in share capital, which was used to purchase Samuel's business. The corporate tax rate is 30%, and it's required on 1st of July 20XO at the date of acquisition to show consolidation journal entries as first, second, show Michael Group financial statement. So our first journal entry is to revalue the asset, which is machinery here. Before we revalue, we are using the net method of revaluation. Before we revalue, we need to take off the accumulated depreciation into the machinery cost so that the machinery cost account becomes carrying value. So we debit accumulated depreciation of 53 and we credit machinery cost 53. Now that the machinery cost account is shown in carrying value, we now revalue the machinery. We increase the machinery cost 10 million, credit revaluation surplus 10 million. That gives rise to a tax. And because the carrying value is more than the tax base by 10 million, we credit deferred tax liability 30% of 10 million, 3 million, and we debit the income tax expense on other comprehensive income 3 million. However, when we close the year, we have to take off that income tax expense from other comprehensive income. So we credit other comprehensive income tax expense. We debit revaluation surplus 3 million. The second journal entry is now to eliminate the investment in the subsidiary. So the investment Michael made in Samuel's business, or now Michael's subsidiary, is 500 million. We credit that and we debit share capital in subsidiary 200 million, 100% was purchased, and retained earnings of 280 million, 100% was purchased. And additionally, we now have a revaluation surplus, which we have now generated through the first journal entry, which is 7 million. That equals to 10 million less the tax rate, that is 30%, and 10 million into, therefore 70% is 7 million. That's our second consolidation journal entry. If we now look at our group spreadsheet, we have Michael, the parent company. It has share capital of 500 million. That raised share capital became investment in subsidiary 500 million. From that, Michael bought Samuel's business, which had share capital of 200 million and retained earnings of 280 million. Together is 480 million. And additionally, there was machinery, which is 480 million carrying value. In combining Michael's parent and Michael's subsidiary, we now enter the consolidation journal entries we prepared. Our first journal entry that we prepared was the revaluation journal entry. We debit 10 million machinery and we credit revaluation surplus 10 million. And from that, there is tax. We debit income tax expense, other comprehensive income 3 million and credit deferred tax liability 3 million. With the close of the account, we need to now take the close of the income tax expense of other comprehensive income. So therefore, we credit into revaluation surplus in the other comprehensive income. We credit that and we debit revaluation surplus 3 million. In the elimination, we eliminate the investment of Michael, the parent, against the shareholders' equity in the subsidiary, so that we can show the assets and liabilities that Michael is controlling in the subsidiary. So we credit 500 million investment in subsidiary. We debit share capital 200 million. We debit retained earnings 280 million. And then we got revaluation surplus. There is 10 credit and 3 debit. Now that also has to be eliminated by a debit of 7 million. Once we have entered them in the adjustment columns of debit and credit, we can now combine the two businesses along with the adjustment columns numbers. When we combine, we come up with machinery, the revalued amount of 490 million. Now we can combine the two businesses, Michael parent and Michael subsidiary. The machinery is now 490 million revalued amount, and there is deferred tax liability of 3 million, which is a credit, and then Michael's share capital of 500 million. Now 500 million is credit, and then we add up the balance sheet assets minus liabilities. We come up with a deficit of 13 million. So what it means is that Michael has invested 13 million more in acquiring Michael's subsidiary business for assets, a collection of assets that can't be individually identified, which are called goodwill, and its goodwill on acquisition 13 million.